Thank you both for joining us today. I'm excited for the conversation. I'll start with you, Rick. If we were to peek over your shoulder at your book this year, what would we notice that looks different from a typical year? You know, where are you leaning in? Where are you playing defense?
So you know, by the way, I think this is about as different a set of expressions versus the year before than I can remember in a while. So maybe I'll start with the equity side. You know, we've shifted around. You know, I haven't been a big believer. I'm not a big believer in small cap stocks. We've moved much more to balance. We've run for a long time big technology position. We still like technology. Every day we get reframed in terms of which technology works. But more balance in the portfolio, more emerging markets, debt and equity, a bit more in Japan. And quite frankly, I mean, some of the financials we've shifted around how and where we own financials. That's been a big difference. In fixed income, it has been, we've rode credit for a long time. I still think credit's going to do its job. There are parts of the credit market that are not very interesting. US investment grade credit trades at tight spreads. We're going to get a ton of supply. We're not going to make any money on it. We've shifted a bunch to mortgages. And then something I haven't said in 5 years is emerging markets have become a good-sized portion of the portfolio, depending on which fund we're running. You know, whereas U.S. high yield was, you know, still okay. We still own a decent amount. But EM has taken the place of a lot. The yield's better. The dollar's going to stay contained. And I will say, by traveling around the world, I was in the Mideast a couple of weeks ago, Asia. I was in Europe a few weeks ago. You know, it used to be I'd talk about EM and people would look at their phone, and which is great for my EM business. But now it's like every time, particularly outside the US, when I talk about EM, all of a sudden people look and say, okay, I want to diversify some dollar assets. That works. Gold works. EM works. So anyway, we like, you know, you got to be a bit careful about in diversifying and where and local versus hard. We're doing a lot more in local. But anyway, those are some of the changes.
Rick, you were about to talk about EM. You were expressing significant amount of excitement around emerging markets.
Yeah.
However, my question to you is, does that excitement extend across all emerging markets, or are you focused on specific plays?
Mostly utilities, because power, I've learned, is a big issue. No, I'm kidding. I like local rates. And I mean, you know, if you got to be willing to take currency risk, I will say I spent some time in the White House and the Fed thing over the last couple of months. And, you know, I will say this is an administration that is comfortable with a I want to say lower dollar, but a contained dollar. And so for EM, that is a home run. So the yields you're getting in places like Brazil, Mex, you know, and some of the forwards in the front are really attractive. The South Africa, you know, we're doing some in corporates as well. Hard currency is not that, you don't get paid that much versus credit, traditional US, European credit. So anyway, I like local rates. By the way, Asia has been, but in credit and in rates has been a good trade, and you know we still like Asia. You know, ex China from a rates perspective and mostly credit perspective. But anyway, EM. I mean, the one thing I've learned about EM, you gotta be really careful about where you go, how you manage it. By the way, we do a lot of overwriting, so like the vol in the EM market is spectacular. So we'll own a bunch of EM current FX rate, local rate, and then you can overwrite it, and the vol you get paid is pretty. So it gooses your yield, which has been a pretty good trade.
Ulrike, so I want to kind of jump to more of the equities side. What are your highest conviction equity and thematic tilts for 26?
Yeah, I think our biggest conviction, Noah, in 2026 is that it's going to be very different from 2025. And in particular, very different from the last 3 years. We think actually some of the headwinds are going to turn into tailwinds and the other way around. So on the macro side, we think the macro picture is going to look brighter. We have 4 global economies, the largest economies in the world, driving fiscal stimulus. And then we have the US still on a monetary easing path. We actually think that inflation is going to be contained this year, and there's room for more cuts because the labor market is also going to remain relatively weak in our view. But then on the structural side, the AI story that has carried the equity markets for the last 3 years, and in particular 7 stocks, and I'm not talking about the Mac 7, I'm talking about what we call the AI 7, the enablers of AI. I think that story is going to shift significantly this year. We are at a point in the capex cycle where we think we are reaching a tipping point. We have gotten immune to these increases in capex over the last year. Every earnings season, there is higher capex than before. But I think to put this in perspective, where we are right now is quite important. Now, $600 billion in hyperscaler capex. That is 2% of US GDP. In fact, it's more than what those 4 companies have spent over 15 years to build out the cloud. And then also the other thing is that capex is accelerating, even at these levels. So if you look at Meta and Google, their capex rose 60 to 70% into 25. Now into 26, we're seeing a 100% increase. So that's pretty profound. It's rising exponentially on the one hand, but then on the other hand, the value capture is not rising exponentially. The technology is, but our structure, our systems, our organizations cannot capture the value quite as fast. And that's where we are seeing a disconnect. And this win-win situation in equities will, in our view, pivot more to a win-lose. The pie is going to be bigger, but they are going to be losers, and we've started to see that this year. So our portfolio expression of that view is one that we call the great broadening. This means geographic diversification, sectoral, but also structural, through the different structural investment opportunities. And it also means for us, and this is maybe different from what you're doing, Rick, we downgraded technology. That's been a big pivot. We have been very focused on US technology in our portfolio the last 3 years. Now we're back to neutral, and we are much more broadly diversified, and in particular, much more focused on atoms, on the physical economy, than the digital economy.
Oh, interesting. Do you share the same excitement for ex-US investment that Rick does?
Yeah, absolutely. For us, this was a big pivot into more geographic, also emerging market diversification this year, but also sectorally for us. We downgraded not only IT, but also communication services. We think the digital economy, the advertising market, there is going to be grabs on the advertising dollars this year, because that's the only way you can justify the capex and also some of the valuations in the private markets. And we upgraded industrials. So for us, it's a pivot away from bits into atoms in our portfolio.
And Rick, do you share that perspective around how to think about all the capex investment that's happening in AI and all the debt that's being written to fund it?
So yes, I mean, say generically yes. I think listen, I still think, some of these hyperscalers, we've shifted. I'm not supposed to go through individual names, but we've shifted in terms of some of where our exposure is. I still think the cash flow, and you have some near-term capex, as Ulrike was saying, you have some near-term capex that's dulling some of the buyback at some of the companies. I still think these companies, though, the free cash flow they throw off, again, if you assume on a run rate basis, the ROE they throw off, pretty impressive. By the way, one thing about building an equity portfolio today, 72% of the market cap sits in the US, and the huge portion, they'd be in the top 10 companies. Pretty hard to build a portfolio without owning them. And so, like Ulrike said, I mean, we've definitely been on balance. But gosh, if when you think about NVIDIA is 5% of the index-ish, you got to buy a lot of mid-cap, small-cap companies to make a difference in your portfolio. So we've been broadening out. And I completely agree in some of what I call the picks and shovels of building the infrastructure around it. And again, some of them are hard because the market cap's not that big. But we've been on a given the size of our portfolios, let's broaden it out. Let's look at the places that are, I would say we did a pretty good job in reducing some software, a lot of software. I still haven't gotten to the place where I think it's worth buying that back yet. Mm-hmm. There are a couple of unique places that are in the software bucket that are actually help chip design that are actually attractive, but I still think we got to be a bit careful. But listen, I think one of the things, the companies that have data, it's not like a short-term trend. If you have data, your ability to build a moat and extend, what is an oligopolistic business is extraordinary around some of these businesses. And quite frankly, I don't think that's going away for many of these companies.
So I want to just stay on the AI conversation, and then we'll come back to some other, topics. But, I can't help but wonder if AI is, in fact, a savior or presenting new risks for markets. Where, Ulrike, do you feel about that?
Yeah, look, if we maybe just take a step back on how we think about our equity portfolio, I think we like as humans, we have quite a constructivist cognition. We like to put things into boxes, and then once we have them in a box, we think we understand them. And I think, in equity investing, it's been this multi-factor model from the 70s, value growth investing, and then different sizes. I do think that AI, to your question, throws a wrench into that nice 3x3 matrix, the Morningstar matrix, and that we need to think about investing differently now. We need to think about what this transformational innovation does to different sectors of the economy and also to different companies. Where's the moat, right, in companies? I think this is a key question. So we are more cautious on the digital side of the economy. Software in particular, look, ultimately, anything digital in the economy right now is not intelligent. And I think now there's a huge opportunity for these businesses to be reinvented through AI, whether it's software or advertising or any other type of digital services. So that makes them, with AI, much more performant. But also because the digital economy is all code, right, 0 and 1s, and now one of the superpowers that we discovered from Gen AI is coding. I mean, what has happened in the last 2 months in coding is truly breathtaking. And I think that generalizes, to other parts of knowledge work probably pretty soon. So our stance right now is to your question of the disruptive nature of AI. Absolutely, it's extraordinarily disruptive in the way we think about even to categorize investments. But I think it's, at this stage at least, for us, the question of what is digital and what is physical is probably the first line of how we categorize our investments, because the digital part is much more easily disruptible than the rest.
Yeah, it still takes the same amount of time to build a building that it did 50 years ago.
That will change soon too, by the way. But now we have already robots building AI data centers. So
that's true. I mean, it does feel though that there's so much investment going on that it's a bit frothy. I think folks in the room would love to know, which play is the next pets.com.
In terms of what's overdone?
Yes.
So I got to tell you, I sold a bunch of equities the day that Netflix and Disney stock got whacked, because all of a sudden you start to think about, okay, so now if we could attack content, what does that mean for the ability to actually destroy large market caps quickly? And that, boy, oh boy, that one was pretty significant to me. So, we're running long equities, but much smaller than we've been. And I have to say that, that when you can actually replace huge parts of market cap quickly, it changes the paradigm. By the way, I flew up, because I want to do something really stupid. I flew up into the blizzard over the weekend, because we had our executive committee strategy day yesterday, and we went through our business and how we think about the go forward, and we think about implementation and how we utilize software, and how we think about managing money. I think people underestimate how extraordinary this is and how extraordinarily disruptive this is going to be for so many different businesses. Obviously, we talk about software, how you deliver services going forward, the obvious ones that have already been talked about. But gosh, now I think you're actually going to get into places, that I think are really, robotics, automation, space are places that I'm investing in both in debt, equity, but robotics, automation, space, away from what I would say is traditional AI, is where I think there's going to be incredible productivity developments. And I would just say one thing, and I'm going to talk about on TV again today. I think people underestimate the impact it's going to have on labor and inflation. That is going to be dramatic. And, so I know we go in different directions in terms of where that's going to go, but I think you're going to disrupt more businesses and more jobs than people give credit to.
I think that's right. I've been evolving in my view on this over a period of time, like everybody has. But anybody who I talk to that's closer to the cutting edge, space in terms of the AI tools is, telling me that it's coming for basically every aspect of the knowledge economy, and everything's going to look very different. So I guess the question I have as a result of that, Ulrike, is this a disruption that will end up benefiting very few, or is it going to ultimately broaden the economy in a way that makes a meaningful difference for folks, even if they do have to retrain?
I mean, ultimately, AI is a scale technology, right? The more data you have, the more compute you have, we're still going through the hardware laws of scaling, the better your models. So very much like the internet, it does ultimately look like we'll have a more oligopolistic structure. I think what's interesting right now is that we're not really there. Yes, we have the public companies, the hyperscalers that are in an oligopoly, but we also have 3 new private companies in the US that are also competing at the frontier of intelligence: OpenAI, Anthropic, and xAI. So this is quite a competitive setting. And then on top of that, we have the Chinese frontier models that are on the heels of the 6 US companies that are in the top of the AI league tables. So for me right now, this looks almost like perfect competition. And in perfect competition, it's very difficult to capture economic profits. So I think what we'll go through in the next, this year and the next few quarters, I think is somewhat of a shakeout process to see which of these companies are going to make it. They're really neck to neck in the league tables. But I think if you look at the chessboard right now, and our view for 2026 is that we'll reach the middle game of AI, where in the middle game of chess, typically that's where most of the piece losses occur. And I do think we'll see more clarity on this front this year. As Rick said, the hyperscalers have one big advantage, which is that they have cash flows from other businesses. These 3 frontier labs in the US outside of xAI, which just merged with SpaceX, probably to solve for future funding needs, don't really have the same amount of cash flows. They don't have net cash on their balance sheet, even some have, but very limited compared to the hyperscalers. And because compute is still one of the key drivers for intelligence and success, I wonder whether we're going to see some more shakeout in the private space this year. You asked about pets.com. I think a lot of people make the analogy between 99 in the public markets and today in the public markets. I think maybe a more relevant comparison is the private markets in AI today versus the public markets back then. Because a lot of the users of AI are actually in the private markets. There are about 500 billion that were invested into AI companies globally in the last 3 to 4 years. They're now worth 3 trillion in recent market valuations, or these private market valuations. So the question is, will all of these companies going to be able to compete at the frontier? And even at the application layer, it's not clear. Now that we are seeing more and more companies like Anthropic, like OpenAI, going into software, and I think the big watershed moment will be when both X and OpenAI are going into advertising.
It certainly seems like AI is creating a lot of volatility in the broader market. Rick, I want to talk a little bit about the role of active investing right now. How much of your investing strategy right now, or investing philosophy right now, is based on specific sector by sector analysis and where the market may be misreading situations, and how much of it is more broad market exposure and allocation?
So By the way, I've learned that humility is a great part of the investment paradigm this year. So I'd give you a stat. So the S&P 500 this year is negative 11 basis points. It's flat. 80% of the stocks are up more than 5% and down more than 5%.
Wow.
So think about that paradigm. By the way, 96% are up or down more than 1%. So point being, if you're not active, then there's a lot going on. And my point about humility, we're having, so far we're having a good year. I mean, we're up, my global alpha fund is up 3.5%, which doesn't, given where the market is, pretty good. I feel okay about it. And then I feel terrible about all the positions I've gotten wrong. And, one of the things that I think that, you become accustomed to managing money for so long is you could be right and the markets just think you're wrong, and or the crowding that's taking place in the market. So some of these earnings numbers, that I read the numbers like, wow, pretty impressive, stock's down 12%. Because there's crowding in positions. I've never seen more momentum positioning than is happening today, like unbelievable. I call it the difference between investing and gambling. I think there's a ton of gambling, huge amounts of zero-day options that are at play. And so you could be right on a name, and you could be right on a name of the intermediate term, but you could be really wrong quickly. So the idea being, listen, we've had a good call, I think, on the macro, and then we've gotten more sectors right, and the balance, getting more balance in the portfolio versus tech has really been helpful. Getting more into Japan, EM has been really helpful. So those sectoral trades have been good. And then, quite frankly, some of the privates we've invested in, they're whether it's the SpaceX, the XAI, the Anthropics, et cetera, have been fantastic in terms of taking returns to pretty good levels. But I would say we're in a mode today, including on the plane down here. Like I am so driven by let's look at this name, let's look at that name. A name I hadn't looked at in a long time that's in our RFID business. Not a big market cap. Let's spend time on that. So. It's the whole panoply of stuff that you got to do, and like I say, you got to be comfortable with being wrong in this environment. Maybe more than we have over the last 3 or 4 years, but like I say, as long as you're getting the broad construct right, it ends up okay.
So outside of AI, what does a good idiosyncratic opportunity look like to you right now?
So, I will say things that are disruption is pretty hard. So I was looking at about today, literally looking at. Airplane, where engines are, some of the multiples have gotten expensive. I was looking at these picks and shovels that I think are reasonable, about the assemblers, et cetera, that I think makes some sense. I will say one that has gotten we've done a decent job on getting into some of the regional banks. We could talk for a long time about disruption in financials, but you've actually repriced some things in financials that I actually think. Some of those businesses are going to be around the way they used to run, I think, for a long time. So, I think there's some interesting opportunities in some of the financials, given how badly they've gotten whacked over the last couple of weeks. So, if you said to me the one expression that I think is going to carry a lot of things going forward is space. Like we are looking public, private, debt, equity convert to take advantage of because I think that's going to be a much bigger expression than people. Data delivery, satellite, military utilization, et cetera, I think is going to be powerful for a long time.
So Ulrike, where do you align with that view from a equity multi-asset perspective? Where do your views differ?
Well, I think maybe to take a step back, we think one of the most overlooked alpha categories in equities is transformational innovation. When you look back at the history of equity markets, they have driven so much of wealth creation. Think about the Bessemer process. Ushered in the mass production of steel, gave rise to a whole industrial sector that was 35% of GDP by 1950. The internet, now a third of the market cap in the S&P. So we think you have to shift the lens from just the traditional boxes of value growth and size, even country and asset class, to think about what is driving the next decade. And we at UBS CEO believe it's 3 things. AI, so we think investing in the disruptor is key, and we can talk about how to do that. The other big opportunity we're seeing is electrification. So this is not just AI data center demand, by the way. This is also electrifying the overall economy, fortifying the electric grid, in the US and Europe, it's heavily outdated. About 5% in the US on energy supply is lost just from outages. I mean, a little glimpse this morning here. So fortifying the electric grid by itself is a big investment opportunity, but then also electrifying buildings, transportation, the industrial footprint. So that for us is a big area of investment. We think this is going to result in $3 trillion in revenues annually. And then I think what's still really underappreciated is the longevity opportunity. For us, this is primarily healthcare at this stage. We think healthcare is actually a sector that's relatively decently valued, still trading at a discount to the S&P PE, but yet has now a couple of headwinds behind it, the most favored nation pricing, the tariffs, and in our view, actually, could be a huge beneficiary from AI. And I think that's still absolutely underappreciated. We have seen, of course, AlphaFold, and people say, well, why hasn't AlphaFold yielded more drugs? Now we have the first drug in phase 2 clinical trials in the US. If we can bend the cost curve on drug discovery, which has, by the way, the EROM's law states that drug discovery has doubled, drug development costs have doubled every 9 years over the last decades. If we can bend that curve, profitability for big pharma companies and biotech companies will look drastically different than today. So we really like the healthcare sector, especially pharma, quite a bit at current valuation. We think actually it's a free call option on AI.
You know, you mentioned tariffs, you mentioned geopolitics. It seems like the market is absorbing the Supreme Court decision and the aftermath of the Supreme Court decision last week. How do you play that going forward? I guess I'll throw a jump ball out for both of you.
So I would say one thing. I think economists got the tariff dynamic wrong. I mean, the U.S. economy is a service-oriented economy. 70% of our services are, 70% of our economy is services. I actually think the inflation dynamic, so core goods inflation last 3 months is running at 0.15%, or I think it's about 0.25%. Last 6 months running about 1%. Tariffs are, you know, we're the largest importer of goods in the world. We're the least, of all the developed market economies, we're the least reliant on goods. So I think that story is interesting and gets a lot of headlines. And by the way, there obviously, we talk about retailers, we talk about autos, we talk about a whole series of components that go inside. I don't mean to suggest not insignificant on a micro level. I think on an economic, broad economic level, you know, depending on how you believe that this will play out geopolitically, you know, I'm not putting a ton of that calculus into how do we think about, listen, the U.S. economy is going to grow. And I think people are going to be surprised. Maybe we'll talk about it later. But I think the U.S. economy is going to grow, I think, faster than people think. And so anyway, so we factor it in. I'm actually surprised the debt market, quite frankly, didn't back up a bit because we need the money. And people don't realize it's $350 billion a year. You need the money.
Right.
And so the part of why Trump's got to do this, we got to diffuse the debt.
Mm-hmm. Before we go, I want to go from where you're optimistic to maybe where you're a little more pessimistic or just disagree with the market. What's a contrarian view that you hold that the market doesn't give you credit for and that the audience should be thinking about? Ulrike, you want to finish it off?
I mean, maybe just also answering your prior question at the same time is I do think AI is the most important lens. I think it will determine geopolitics. It will also be determining where rates are ultimately through inflation and also labor market dynamics. And then if we think about AI, I think one of the most underappreciated facets is that all this capex spend that we're now seeing is based on one algorithmic breakthrough, and that was the Transformer paper in 2017. Attention is all you need. And this algorithm gave rise to this new wave of generative AI. But this algorithm, as powerful as it is still falling short of our human intelligence in a number of very significant ways. In particular, that it is much less sample efficient and also much less energy efficient. So I think one potential wildcard could be that someone could come up with a new algorithm that is much more energy and compute efficient. Think about it like the multiplexing moment in '99, when suddenly we could send more than just one signal through the fiber. If we get a new algorithm that needs less energy, less compute, I think that's something that we need to watch, because that would make some of this capex spend a little exaggerated at this stage.
And Rick, final word.
I'll throw out U.S. economy, I think, is going to grow 5.5%, and rates have to come down. I think that, I'll say, sitting in front of the president, he definitely would like rates to come down. That's a lot of wisdom. I think the dynamic is going to be powerful around productivity, innovation. I think we have a labor problem, and I think there's something significant. And I was just reading a paper from a Canadian, one of the Canadian central bankers that was brilliant, about people don't realize that you've got to keep in, when you go through this evolutionary change, you will bring inflation down. When you bring inflation down, you've got to let the economy breathe, and you've got to get labor transition. The big problem in the US today is we have a debt burden that's too large. The only way you diffuse the debt burden is we've got to grow the economy at 5% plus, and we've got to get the debt rate of the debt down to 3, and then you diffuse the debt. So I think people underestimate that. By the way, 89% of the US economy's debt is in the front end, is 2 years and in. And so everybody I know is in a steepener trade. There's actually not that much duration out the curve. And I think people will be surprised, like the last week or so, that you can actually have an economy that grows faster than people think, and actually rate can come down, and actually the back end can be much more contained than I think people give credit to.
Well, Rick Rieder, Ulrike Hoffmann-Burchardi, thank you so much for joining us today.
Thank you.